Hmm.
I think that what we're facing in global financial markets, in global institutions, particularly financially related, like central banks, and the nature of money
Hmm.
that's put out by government could change. I think so many things are going to change in the next year or so that you're not going to top gold, that it's going to level off and be institutionalized again as money.
Hmm. Hmm. Hmm.
This government, that government. Finally, the US probably be the last one to do it, where suddenly it's a gold-backed currency.
In today's markets, the discussion around precious metals has become impossible to ignore. Silver and gold are no longer just safe haven assets in the background of financial discourse. They are increasingly being recognized as central to the unfolding global realignment in money, trade, and investment. Michael Oliver, a veteran technical analyst, has built a reputation for spotting long-term market momentum shifts well before they become obvious to the mainstream. His latest outlook on silver, gold, and the broader U.S. economy is one of the most compelling in years. For silver, Oliver believes we are entering an acceleration phase that could push the metal far beyond its outdated benchmarks. He notes that silver has already outperformed gold over the past year, and that the historical relationship between the two metals suggests silver still has enormous ground to cover. In his analysis, the ratio of silver to gold has often doubled from where it sits today, and he argues that the technical momentum building in silver indicates a surge is near. That kind of move would not just surprise investors, it would force a fundamental reassessment of silver's place in the monetary and financial system. Gold, meanwhile, remains firmly in an uptrend. Oliver stresses that despite recent strength, the yellow metal is nowhere near exhausted. If past bull markets are any guide, gold could rise several multiples higher before even approaching a top. He goes further to suggest that gold may soon become institutionalized once again as money, with some governments eventually turning back to gold-backed currencies. Such a development would be transformative, particularly for the US, which he believes will resist the longest, but ultimately have no choice. Overlaying this is Oliver's assessment of the US economy and financial system. He points out that the long era of fiat currencies has lasted just about one human lifetime, and that experiment is now fraying. With debt burdens, banking sector risks, and persistent inflationary pressures, he suggests that gold and silver are simply reflecting the decay of monetary value over time. For investors, this is not just about trading metals, it is about navigating a possible redefinition of money itself. As we unpack Oliver's insights, we will look first at his analysis of U.S. Treasuries and equity markets, then turn to his in-depth forecasts for silver and gold, and what they could mean for the financial order ahead. If you find value in these discussions, make sure to subscribe, like this video, and stay tuned for more in-depth breakdowns of global markets.
Long-term analysis of T-bond futures, where you look at 30-year bond futures, been around for decades. Okay. We turned major negative in October 2020. Okay. And bonds then were 170 in price, a little over there actually. They dropped by 2022 down to near 100. Okay. So they had a big collapse, meaning a huge rise in yields. Okay.
Right.
But since then, you could draw a line. If you get a yield chart, which would be upside, or price chart downside, you could draw a line from October of 2020 and draw a line across the chart. We haven't moved much. In other words, if it's a base in price,
Hmm.
it's had its opportunities and it's had numerous 2 or 3 rallies efforts to get up out of the muck. Okay.
Hmm.
And it gets up into the 120s on T-bond futures, and they puke it right back down to 110 again. It just can't seem to get itself going. There's been 2 major efforts. This, I think, is the third effort to get up out of here. I don't really think it's going to get really up out of here, so to speak, in a way that sustains. But I think you could get what we call a major counter trend rally, meaning while the long-term metrics look negative, technical metrics, you could get a counter trend rally against that is like maybe last 3, 4, 5 months, that kind of thing. And it would turn heads. People, oh boy, I got to buy bonds. Bonds have not been the alternative to the stock market that they have been in prior bear moves in the stock market. So, for example, in the drop we had from January to April in the S&P, if you look what happened at the end of April for the bonds, they puked. they dropped in 2 days from like 121 down to 111, like boom.
Oh, yeah.
Like that's a crash. So T-bonds weren't behaving opposite to the
Mm-hmm.
stock market. So large portfolio managers who might be skeptical
Right.
of and want to move, 2, 3, 4, 5% out of the stock market into something they used to perceive as safer have been reluctant. It's not worked.
Mm-hmm.
But I think it might work now.
Mm-hmm.
And we've already crossed through some numbers this month that are fairly far below where you are right now that suggest no, we've sort of broken out and we're going to get some kind of rally.
Mm-hmm.
From an investment point of view, I think the rally is a non-event.
Yeah.
From a trading point of view, yeah, you want to trade? Fine. There's probably a trade here. Buy T-bond futures, buy TLT, scoop out some money over the next several months as it goes up, and probably this stock market goes down. So finally, maybe the bonds act inverse to the stock
Mm-hmm.
market. Finally. But the ongoing alternative is always, what? Monetary metals.
What is your outlook on the equity market now?
We still think technically that we're in a we're not troublesome, languishing top in pattern. We think that late last year, early this year, S&P was, we're about 9% or 8% above it right now. Okay. I think
Mhm.
that was part of the topping process. I think this is also momentum says no, do not trust price new high.
Mm-hmm.
Quite often it tops in the stock market. Whether you look at 2000, we turned bearish in January. That's the dot-com market of 2000. Well, heck, by August they made a new high monthly close in
Mm-hmm.
the S&P. Okay, and it was enough to for people to feel so comfortable, and it's going up forever because it's been in a holding pattern. Now it's just pushed to a new high close. It was all a trap.
Mm-hmm.
It didn't work. In 2007, we predicted in 2006, the close of that year, that we'd go up into seven and top, and the probable topping area would be 1550 to 1600.
Mm-hmm.
And what we were saying then is we're going to go up and take out the price high we saw in 2000,
Mm-hmm.
which was 1550.
Mm-hmm.
So how could we predict a high, a top that's above the old high? That should be bullish, right? Okay. But
Yeah.
what happened in the spring of 2007, the S&P went up to 1550 again,
Uh-huh.
back to the 2000 high, and dropped into the summer. And so a lot of the price charters said, oh, look, a double top.
Yeah.
But then it started to turn up June, July, August, in September, the Fed cut rates. It was a surprise. It
Mm-hmm.
was an ambush cut. It wasn't like the one we've already priced in and
Right.
anticipated.
Right.
They cut rates, and for the next 3 weeks into October of 2007, you went up to 1575.
Mm.
Okay, think about a price chart now.
Yeah.
1550 in 2000, 1550 in 2007 in the first half of that year, back off. Then you come up and you break through that high, those dual highs. Isn't that bullish?
You would
Right?
think so.
Yeah.
Normal.
Okay, that was the top. Okay,
Mhm.
period. If you sold that, you nailed the top. Okay.
Yeah, but a lot of
And
people were thinking that's bullish. It's time to.
oh, sure. Well, what are you doing now?
What were your momentum charts telling you then?
The momentum charts told us even in 2006, you're about to make the top, and we had a target zone, and it turned out we were dead right on the target zone. That it was, in fact, high enough target zone to where you took out the old high. And therefore, the point I'm trying to make is don't just look at the price charts.
Right.
So
Well,
we took out the January high. Oh boy. By the way, when you talk about the Mag 7, it's more like the Mag 3 now.
is it?
Okay.
Yeah.
The 3 or 4. It's not the 7 anymore that took out the old highs.
Mhm.
Okay. So you're even losing leadership there in the leadership area.
Uh-huh.
Okay.
Uh-huh.
So it's not what you think it is. And I think you're right. We're losing, participation in this. This is narrowed quite a bit. And I think that there's a good chance in the fourth quarter we're going to see downside damage. And I would not be looking so much at tech. I think it'll go down because
Mhm.
it'll lead the way down as well. Watch the financials.
Wow.
In particular, we're watching about 6 major banks, and we're watching the major credit card companies, Visa and MasterCard. They have momentum trend structures on them, meaning if you look at the momentum chart, you see what looks like a floor,
Mm-hmm.
which was not broken in April, okay?
Mm-hmm.
But it's been used so many times, And you're not far from it right now. So if you ooze down just a little bit between the now and start of the new quarter, you're going to be sitting on death's door again.
Mm-hmm.
And it could be a fourth quarter event where suddenly you get an ambush in a sector you weren't looking at,
Mm-hmm.
one that's too important, financial sector,
Mm-hmm.
credit card debt. The banks won't like that either. So
Well,
we're still arguing that there could be a major bear. Now, you made a good point.
Oliver's review of the U.S. Treasury market highlights a deep structural problem. He argues that despite multiple attempts at recovery, long-term bond futures remain in a downward trend, showing only short-term counter-trend rallies rather than any sustainable strength. This has eroded confidence in treasuries as a traditional safe haven. At the same time, equities are displaying classic topping behavior, with narrowing leadership and rising vulnerability in the financial sector. Oliver's warning is clear. Markets may be heading into a fourth quarter event where banks and credit card companies lead a sharp downturn. But the more dramatic story comes from his analysis of silver and gold. Silver, in his view, is breaking out relative to gold and showing momentum that suggests a powerful revaluation lies ahead. He sees this not as speculation, but as a return to historical norms, where silver has routinely doubled its current relative performance. In this next phase, Oliver expects silver to outpace gold rapidly, carrying prices well beyond their past highs, while gold itself continues to climb toward levels that would imply a reintroduction of sound money.
Yeah, what we do to measure silver gold, unlike what most people do, we divide 1 ounce of silver to 1 ounce of gold, express it as a percent. So
Mm-hmm.
right now, silver's traded at about 1.15% the price of gold.
Uh-huh.
You go back 50 years, and we showed a graph of what was the highest reading each year of that silver divided into gold, highest monthly close, okay?
Mm-hmm.
And 21 of those 50 years, it was at least 2%.
Mm-hmm.
Okay. That was almost a norm. In fact, it didn't in the bull market years, 78, 9, and 80, 2010 and 11, for example.
Yeah.
Silver was up 3.5 to 6% price of gold. Okay. But right now we're coming up off of a low that was just below 1%. And technically, when you examine the spread, which is effectively, it's a price chart. It's the
Mm-hmm.
price of silver, price of gold. And we
Sure.
also run momentum of that spread. We're starting to get breakouts. And over the last 5 months, for example, if you look at what silver's done versus gold, it's beat gold solidly.
Mm-hmm. Mm-hmm.
Okay. And I think that's the onset of a major shift where at minimum, silver's going to gush up to the 2% level again, which is,
Mm-hmm.
again, that's not even extraordinary. It's routine. Why aren't we there now? Now, also another comment I'd like to make is, where's gold versus 2011 high? Well, it was 1920, it's 3,700. Okay, no issue about the 2000. Where's copper, a base metal?
Yeah.
It's trading above its 2011 high.
Uh-huh.
Okay, so is it outlandish to say that, hey, maybe markets have made a mistake?
Mm-hmm.
We know that historically. Markets get overdone. Markets get overdone on the downside, and they sit there and people say, oh, it's garbage. It's no good. And it's a mistake by a lot of investors. And finally, when reality hits, it wakes up in a way that jars everybody.
Mm-hmm.
Well, silver is one of those situations. And its spread is arguing it's ready to ramp again. Its price action has begun to indicate that relative to gold. And it's up more in a year than gold is. Even just go back a full year, it's up more. And I think it's going to rampage over its old dual $50 highs, which are ridiculous old notions anyway. They're antique price highs.
Yeah.
And we're only up there for hours, by the way,
Yeah.
not weeks or months. And I think this next surge is going to carry us, this is not the top, by the way, into the 60s and 70s, the next surge. And I think it could happen this year.
Wow. Wow.
So, and now that's not the end of it. Ultimately, it wouldn't shock me that gold goes to its normal high. And by the way, I hear this on CNBC, et cetera, like gold it's gone vertical and you should sell vertical and buy, gold is not even halfway up in dimension, percent gain.
Uh-huh.
And what we saw from 1976 to 1980, an eightfold move, or from the 2000, 2001 lows to the 2011 high, an eightfold move. Gold would have to be about $8,500 to just match the dimension, the
Mhm.
ratio move of those two prior bull markets,
Mhm.
which occurred under circumstances that are far less earth-shaking, globally dramatic than what we're facing right now.
Right.
So
Well,
gold going to 8,000 would just be, I will say, oh, so what? December of 2015, gold was
15.
$1,045. Okay.
Right,
That
right,
was its bare low.
right.
Okay. So you've tripled in a half. Okay. Not eightfold. Okay. Uh, you ask about when does it end and where is it? Uh, I have a different view on that.
Mhm.
I think that what we're facing in global financial markets, in global institutions, particularly financially related, like central banks, and the nature of money
Mhm.
that's put out by government could change. I think so many things are going to change in the next year or so that you're not going to top gold, that it's going to level off and be institutionalized again as money.
Mhm.
This government, that government. Finally, the US probably be the last one to do it, where suddenly it's a gold-backed currency.
Mhm.
Uh, and it doesn't collapse again because we're back to a gold standard. We got off that with Roosevelt, and then Nixon helped.
Mhm.
Uh, it's only been, 100 years that we've had the Fed, and about that we had Roosevelt, take everybody's gold from them. So it's not like it's forever that you have fiat currencies.
Mhm.
They've been an experiment of one long human lifetime.
Mhm.
And if it doesn't work well, and I think reality is going to demonstrate that, not just here, but elsewhere in the world,
Mhm.
then the public is going to get upset. There's going to be emotion. Trends will be destabilized. And I don't mean Trump as a destabilizer. I mean, even he might be destabilized by the new forces, where we
Only God
go
knows. Yeah.
toward, real money again.
Yes.
And
Yes.
all gold is expressing over the eons, decades, is the ongoing decay in the real value of money.
Yep.
Your granddad built a house, cost $4,400.
Mhm.
Today it's 450,000.
Mhm.
Okay, it's because of the decay in the money unit. I don't mean dollar versus yen or euro. I'm talking dollar's real buying power.
Mhm.
Gold simply expresses that. It inhales and it exhales, but it keeps up with that ongoing decay. And I think we're going to be institutionalized. Wouldn't surprise me. Silver as well. Well, if we did a spread also of GDX versus or SIL, the silver miners ETF
Uh-huh.
versus GDX. GDX does contain about 10 silver miners, by the way, so it does have
Mhm.
some in there.
Mhm.
But SIL is breaking out on a spread basis versus GDX. And we're just looking at the spread chart. It's really pretty much matched GDX for the last couple of years. It's held par status. In other words, it dropped from its 2020 highs versus GDX more than GDX did, therefore it underperformed. But over the last couple of years, it's really sort of gone sideways versus GDX in terms of relative gain, et cetera. But it's broken out now. And it looks like it's the same assumption we're operating on with silver versus gold. I think silver is going to outpace gold rapidly. I think
Mhm.
silver miners are now going to be the better place to be among the miners than the gold miners. Not
Mhm.
that the gold miners will do bad, but I think the silver miners will now catch up
Mhm.
because they're as underpriced as silver is. Uh, for instance, GDX is out above its 2011 high.
Mhm.
XAU index out above its 2011 high.
Mhm.
SIL is in the 60s. Its 2011 high was 90.
And
It's
where
to
did
go
it now?
50. It's in
Yeah.
the mid 60s right now. It
Right.
could go up, nearly 50% just to get to it. So I think there's a lot of catch up that's going to occur. And my personal investments are more emphasized in silver miners, and I even do options.
Michael Oliver's forecast for silver is striking because it challenges the complacency of markets that have written the metal off for years. For decades, silver has been suppressed by perceptions of volatility and by the dominance of gold as the primary monetary metal. Yet Oliver shows that in almost half of the last 50 years, silver has traded at twice its current relative value to gold, and in key bull markets, it has gone much higher. That historical context underscores his argument that silver's current levels are an anomaly, an undervaluation waiting for correction. Gold's trajectory complements this outlook. Oliver points out that gold would need to rise to nearly $8,500 just to match the magnitude of its past bull runs. Importantly, this projection is not based on hype, but on historical precedent. What makes this cycle different is the backdrop: geopolitical turmoil, record sovereign debt, and eroding faith in fiat currencies. Under such conditions, a return to a gold-backed monetary framework is no longer unthinkable. For investors, that raises the stakes dramatically. Gold is not merely a portfolio diversifier, it may once again become the bedrock of global finance. The equity and bond markets add further weight to this thesis. Oliver's view that treasuries may no longer function as the natural counterbalance to equities is crucial. If stocks decline and bonds fail to provide safety, institutional investors will be forced to consider alternatives. Precious metals and mining equities stand as logical destinations. Already, Oliver sees silver miners beginning to outperform gold miners, a trend he expects will accelerate as silver reasserts itself. For investors willing to move ahead of the curve, this shift could present generational opportunities. Beyond the charts and ratios, Oliver's analysis speaks to a broader truth. Fiat money has been an experiment, and one that appears to be nearing its limits. The US dollar, despite its global reserve status, is losing real purchasing power. Housing costs, consumer debt, and financial instability are reminders that the money unit itself is weakening. Gold and silver, by contrast, endure as expressions of value across generations. This is not about speculative surges, but about wealth preservation in an environment where confidence in paper assets continues to erode. For serious investors, the takeaway is clear. The months ahead may bring volatility and short-term countertrend moves in bonds and equities, but the long-term trajectory for precious metals is higher, much higher. Silver is poised to reclaim its historical role, gold remains far from a peak, and the institutional landscape may shift in ways few expect. As always, thank you for watching, and if you found this analysis useful, don't forget to like, subscribe, and share this video with others who are looking to navigate these turbulent markets with clarity and foresight.